Welcome to the Dividend Talk podcast, episode 244. Earnings season is in full swing. Hey, European DJ, it's our favorite time of the year again. Earnings are back.
Yes, definitely. And this is the first quarter earnings, right? So we
Yeah,
always get a little bit of a flavor of, okay, fine. We just had all the annual results. You could drink, eat your free cake and then drink your coffee, right, at the annual general meetings. But now back to business. So, and we had quite an interesting quarter, of course, with a new president in America. So yeah, never a dull moment nowadays, right? So it's really interesting to see what companies are bringing up. And what is your feeling so far if you look at the earnings?
it's a bit of a mixed bag so far. There's some positive results, and we'll
Yeah,
get to some of them. And then there's some of them who are cautious, obviously talking about the tariffs a little bit and how
yeah,
this volatility might impact them going forward. So I feel it's been mixed.
yeah. In the beginning, I felt like, okay, this one -10, this one -8. Yeah, but now the last few days, specifically the Europeans are doing quite well, which is also interesting.
Yeah, but I think I kind of expected that when you look at the macroeconomic environment out there.
Yeah.
It's a bit volatile in the US, so you kind of
Mhm.
expected a little bit. But yeah, roll on more Europeans and European dividend hikes. That's what I'm looking
Oh,
forward to
yes,
the most.
yes. True. I'm looking forward for the payments because May is like, oh my God, I need a truck.
Yeah, May, June. I think June is my best one as well. So
Oh, June as well, yeah.
May and June are good. So it'll almost double my dividends in the space of 2 months from
Yeah,
what I get the year.
exactly. So are you going shopping?
Nah, compounding, baby, reinvesting.
But you will shop then in the stock market, right?
Ah, of course.
Will you invest everything back? Is then also May and June the months where you spend way more on dividend stocks?
Yeah, of course, everything gets
Yeah,
reinvested. I'd never take anything
yeah,
out. Do you know what I kind of wish though, because I have drip turned on for US stocks on interactive
yeah,
brokers, but I wish we could do that for European stocks because
yeah,
there's some that I would like to do that for. But yeah,
yeah,
of course, everything gets reinvested. I'm looking forward to getting rid of Enagas
yeah.
soon, hopefully. So I should have lots of cash to reinvest this month and next month.
But aren't you afraid sometimes that, for instance, I don't know, they always say like sell in May and go away, but remember to come back in September, right? Aren't you afraid, for instance, that you always buy maybe at the high point before it goes low, or
That's for total return investors. I mean, we have a long term perspective. We're thinking
good answer.
10 years. I'm not thinking September.
Yeah. Oh, good. No, really, yeah, I'm really looking forward to it. I mean, the insurance dividends will come soon as well. Oh, they're
And
so
they still look attractive, which is annoying. Like I have so much,
yeah, I know.
I have so much. But
Yeah.
anyway, look, we'll get on to talking some earnings in a few minutes. So I think we have 5, 6 really good companies to talk
Mhm.
about. But what's been going on in the news? Anything strange? Anything happen?
Well, only one thing I would say. We got an email this week from a company, from a website that lists and ranks all the podcasts. So
Yeah,
we are the number 26 on the list of finance podcasts in the world.
it's
And,
crazy.
you could say like, 26, that's not the top 10, but come on, we're in a niche dividends. Yeah. From all the finance, if you think about the big ones, so the first few are like David Ramsey, Jim Cramer, and this
CNBC,
Island, yeah,
Motley Fool.
acquired all of the hot shots, right? And then somewhere there, suddenly in between, you get Dividend Talk.
A Dutch guy and an Irish guy talking about European dividends. How niche is that? And
Yeah, but because it looks like all the rest is kind of American
yeah,
in there. Yes, so I was really proud when I saw that. I know that there's also a list about podcasts that are specifically to dividend investing. That's where we are already standing for a few years. Number one, it's just a very small niche when you think about it. But this one blew me away because I wouldn't have expected number 26. Really not.
no, I wouldn't. Look, I don't know how he calculates it or what kind of algorithm they have, but yeah, 26. I was quite impressed with myself. I was like,
Yeah.
wow, I can't believe that.
Yeah. On the other end, Spotify, right, also always says that we are in the top 1% of all podcasts. It tells you how many podcasts there are. It tells you also how difficult it is for podcasts to get listeners, and also most podcasts die within a year.
Yeah, of course.
Yeah.
I mean, it's tough. Could you imagine doing this on your own? Like a lot of podcasts are single people just
Yeah.
speaking into a screen. That must be
I think so. Yeah, that must be very
really
tough.
hard.
And I think if you or I would be alone, we would have also thrown in the towel earlier.
Yeah, it would not have lasted 12 months. I mean, it feels easier when there's two because at least it's a conversation. You're talking to someone, not talking to a mic. But yeah, look, 26, it's quite good. But look, we need to get to number one. That's where we need to get to.
Well, let's start with 25 first. That's a round number so that we can celebrate. But look, honestly, if you think about how this works, right, ratings are really important. We got more than 300 people that rated us on Spotify. The average rating is 4.9. I mean, that means just that we have awesome listeners. And we know that already from the Facebook group, from Twitter. Our community is awesome. They are always so friendly for us. And there's just a lot of passion in this community. And yeah, without the community, this wouldn't be the case, right? Without listeners, without a community, we are nobody. So.
Exactly. So thanks to everyone for listening. We do appreciate each and every one of you. But let's get back to what we're good at, and that's dividends. And there must have been some dividend announcements this quarter.
Yeah, let's start. Cisco hikes the dividend by 5.9%. It's a company that you have looked into once in a while, right?
Yeah, about 4 or 5 years ago. It's a company that I was looking to add to my portfolio. They're in the food industry, but I never pulled the trigger. Okay. But they good dividend history.
Yeah. Well, the second one is interesting for me, NASDAQ, because they hiked the dividend with 12.5%. And if you think about it, right, we have S&P Global, NASDAQ, CME Group, Deutsche Börse,
London Stock Exchange.
These are really compounders, right? Unbelievable.
The companies are really, like, obviously I've done a deep dive on both CME Group and London Stock Exchange. I'm really impressed with London Stock Exchange. But I would imagine NASDAQ will be quite similar to the LSEG. So yeah, and I don't have a position in any of them, so it's something that I need to fix. But
all those companies are like really doing well.
Yeah, especially if they offer data solutions. I think that's where the growth is.
Well, then another double-digit hike from Parker Hannifin, 10.4% increase.
Nobody talks about this company. It's a dividend king, I believe.
Yeah.
At least Aristocrat. I know a little bit about it. I know it's into like motion and control. I should know a lot more about the company, seeing it's my area. But it's a company that I think it's low yielders, which is the problem, which is probably why it misses our screeners. But yeah, solid company, 10.4%.
Exactly. And then we go to the tech companies, right, where you usually also would expect double-digit hikes, but Qualcomm, I would say only a 4.7%. And then Google, only 5%. A bit disappointing, I think, for people invested in those stocks.
Yeah, I think so. I mean, Google is going to be our first company that we'll speak about in terms of earnings, but I look at the 5% in two ways. One, you look at the cash flow that they're generating and say, right, it is disappointing. But on the other hand, it's the first increase, I would think. First increase. So it does show that it's not a flash in the pan either, that they are taking the dividend a little bit serious. Not going overboard, of course, but 5%. While disappointing, it's better than nothing, I would say.
Yeah, don't watch a gift horse in the mouth, right?
Exactly.
That's what you're saying.
Exactly. But sure, look, we might as well jump straight into Google's, will we?
Let's do it.
Marco asked us about Google and their dividend hike and what we make of it.
Yeah.
So first of all, the numbers, and wow, revenue was up 12%. Up to 90 billion. I mean, we're talking big numbers here for such a company. Operating income was up 20%, net income up 46%, which means earnings per share was up 49%. So it's actually quite strong. They're still growing. And what's interesting is that their search volume is growing again. So we spoke about AI and how they're going to tackle this, and we had ChatGPT. But I don't know if you noticed this. I know you were using Bing for quite a while.
Yeah.
But now when you Google, you get AI Gemini, and it
Yeah.
gives you nice little breakdowns on the top of your search. And
Yeah.
I find it really, really good. I actually find it better than Bing at the moment. But that obviously has boosted their engagement. They have 1.5 billion users per month, which has drove their revenue up. Google is obviously, not Google, YouTube is quite strong, and Google One has over 270 million paid subscribers. It's just like, it's like an ecosystem, and once you're in it, you're just not getting out of it. So I think the numbers are really strong. The cloud business is also up 28%. And then, as I said, YouTube was up 10%. So quite strong numbers. What I will say is they did raise the dividend by 5%, which was disappointing, but they do prioritize repurchasing of shares, which they repurchased 15 billion worth. Now, over the last, I would say, 2 or 3 months, everybody's been talking about how cheap Google has been.
Yeah.
It seemed to be on everybody's lips. So when you think of it on that aspect, buying back shares instead of dividend hikes, it probably makes more sense. I mean, they're trading at around a 20 PE. I think they dropped as low as 18 at one point. So, I mean,
there is one catch, right? When you look at the EPS, because you see, for instance, the quarterly EPS last year was 189 and now it's 281.
Yeah.
And you know that the other income is 11 billion this year, and last year it was 2.8 billion. For our listeners, other income is not income from the operations.
Yes.
Yeah? Do you know where this 11 billion comes from?
No.
They have a Warren Buffett there at Treasury, who was able to generate 9 billion in profits on their equity investments. So, you know, they have equity on they have like always cash equivalents and short-term investments on the balance sheet. In this case, they were able to earn 9 billion, which is amazing in a market in Q1. Yeah, but I think the stock market really went down at the start of Q2, right? Kind of.
Yeah. Just near the end.
Just near the end.
Yeah.
So, yeah, there's been a Warren Buffett there, a little Warren there in the Treasury Department that was able to generate 9 billion. So if you deduct the 9 billion from that, then the income would have not been 34 billion, but rather, let's say, around 25-ish, 26. So let's say 3-4 billion. Yeah, let's say 5 billion more. 5 billion more than what it was right now. Yeah. So that also means that the EPS would probably somewhere around $2.30. So there's like a 40-50 cents in there, which comes from a one-off equity investment. And you may have suddenly next quarter a 7 billion minus. You don't know, because of how the stock market is going. So I think it's important to take those things into consideration. And always therefore read the income statement, because if you see in the income statement, it's really simple to see it. Suddenly you see other income expense and you see like, okay, 2.8 and suddenly 11 billion. It should ring a bell to people. If it would have been like 3 billion, 2.5, you think, like, okay, somehow similar, but this is kind of an outlier.
Yeah. But ignoring that, I mean, there's no point getting carried away with one number in terms of earnings per share. But if you look at the revenue, even operating income before you take that other income in, you can see that the growth is quite strong. But like that, if you have a Warren Buffett there that's generating from, say, equity holdings or whatever he's doing, there's a huge chance that they could lose that at some point.
Yeah, true. And I think it's just impressive that they are able to continue growing their ads business while ChatGPT is there, because I spend a lot more time on ChatGPT and everything than I used to do, let's say, on Google.
Yeah.
But I'm not a 60-year-old person with thick fingers behind the keyboard who doesn't even know what ChatGPT is. Yeah. The majority of the world is in that space still. Yeah. And they're growing. So that's good. Growth is slowing down. That's important to recognize. So I wouldn't straight away pop the bottles, the champagne. But generally speaking, these are very, very good numbers. And it's good to see for this company, because we need a strong Google a little bit in this ecosystem.
Yeah, the worry was always around this. Well, it wasn't even a worry, but it looked like they were static in this AI world for a while. But
Yeah.
we know they had the cash behind them. They could afford to wait and let other
Yeah.
people maybe make the mistakes and come in with a better model. But I have to say, I do really like Gemini, and it's really good because we record on
Yeah.
Google, and I get a transcript, and I can just say, "Tell me what I talk about," and it will summarize it quite nicely for me. So it's
Yeah.
I like Gemini. I do.
Yeah, no, they are now back in the game, I would say. We've been making jokes about it for some time. But it's interesting, right? Because people always talk about first movers advantage, and those first movers always get awarded and they're praised a lot. But we had Alta Vista and
Yeah.
Yahoo for search before Google came in. Yeah.
Yeah.
So I would say at the moment it's the Wild West for Gen AI. And at a certain moment, this will consolidate. Yeah. And that's when the winner will really come out there. And I think the game is still on. It's an open playing field. And we'll see how that plays out.
Yeah. How easy was it for you to ditch Google and to move to maybe ChatGPT or Perplexity? Was it did you find that a difficult transition?
No. There was no switching cost at all for me.
No, just didn't even think about it.
No, because you're not hooked into an ecosystem. This, actually, during my study 12 years ago, I studied such cases. I studied about two-sided platforms, and I studied about the network effect. The network effect is really, really strong for people. And network effect is, for instance, because you're, let's say, on Facebook or your friends are there, and you're likely not really to change the way. Yeah. Unless the whole platform becomes, the culture or something like that, but that's usually not the case. Usually it's the case for these kinds of things that there comes a brand new technology and that disrupts everything, because that new technology removes the switching cost. So if you're in the Google ecosystem with search, it's really hard to switch because of the usability, the integration with all the other things, with Chrome and everything. So you're in an Android, you're an ecosystem. But if there comes an entirely new technology that creates entirely new capability that was never there before, and that was search as well, right? Search came after the start pages everywhere, the link pages, right? That's the moment that users can much easier switch, because there's so much value in the other one, the other ecosystem, that just removes a lot of the switching cost. So when you think about mode, I always say, like, mode only exists until someone discovers the rocket. Because if you think about a castle mode, you could do some, you could protect your castle with a mode, but if then someone came with a cannon, there was your mode.
Exactly.
So this is how I look at all of these kinds of things. So mode is a little bit ambiguous for me always. Of course, we talk about it. It's a famous term also coined by Warren Buffett and the others. But two-sided platforms and the network effect are very strong, and usually this only becomes neglectable if there's entire new innovation, technological innovation. And that's what we're seeing now. That's the era that we are living in. And if Google is not innovative enough, then in 10 years from now, we will talk about Google as about MySpace and all of those. The good thing is Google is very cash rich, has been investing in DeepMind for many, many, many years, is investing heavily in CapEx. They have really talented people. And that's why they are able to even though they didn't do well, because I know I read some articles about it, how Google recognized that they were too slow, the typical corporate, and then the CEO created a team and put all the focus on that team to release as fast as possible. That's what they're doing now. And what this tells me is that they have great leadership. I'm not a fan so much of the CEO, but if they pull this off, and you are such a behemoth, and you are so fat and rich from the ads business, and you are okay cannibalizing it and all of this, then that for me is real leadership. Because otherwise, look at all the other companies in the past. They're like the Nokias of this world. There are so many examples where leadership was stuck by active inertia, and they just couldn't do it because they were used to run business models that would make them successful, and they were not able to jump on the new thing that was there to stay.
Yeah.
So far, I mean, Google is still in the game, which is really nice to see, and the earnings were really good this season,
Yeah.
this quarter.
Yeah. I mean, I don't own many of these or any of these type of companies, but I'm tempted with Google, I have to say. I'm very tempted. I like what they're doing there, and the one thing that they have an advantage on over everybody else in this space is probably data, and lots of data. So let's see.
Yeah, I own a few shares. I was considering maybe to add a few more, but I was more thinking about making that's it. In this time, looking at some dividend stocks that I always talk about and always say they are too expensive, so I put my attention there. But I do own a few shares in Google, and my average cost per share is it's a bit lower than what it is now. So
nice. Yeah, I fall into that trap. I want to own Google, but then when there's so many good dividend companies on sale, I forget about Google and focus on where my actual priorities are. But yeah, look,
exactly.
Good quarter. We move on to some European companies, and we have to talk about Unilever, don't we?
Yes.
I don't know if you saw the earnings, but overall they've had they report this underlying sales growth, don't they, which can be quite confusing, USG, but they've seen underlying sales growth of 3%. And that includes a mix of price and organic volume growth. So when you break that down, they saw 1.3% growth in volume and 1.7% in price. And I'll get to that later on. Their overall turnover was down just about 1%, and that's including kind of FX and stuff like that. So their overall sales was down. They are confirming that they're spinning off their ice cream business. So they have mentioned the Capital Markets Day on the 9th of September. So stick that in your diary. And I think the company is going to be called the Magnum Ice Cream Company, which I think makes sense. It's their flagship. Wow. It's their flagship product, and it's going to trade in Amsterdam and London. They've increased their dividend by 6.1%, which was surprising, I know, but they've done that. And overall, look, they talked about this power brands, and that grew at 3%. Some of their largest brands, such as Dove, grew 8%. Then you had Vaseline, Liquid IV, and Magnum is a power brand, which they're going to lose as well, contributed to some of that growth. So look, overall, I think it was quite a solid earnings from them. Kind of what's expected. They've predicted between 3 and 5% USG, which is what they've done in this quarter. They're doing that for the whole year. It's nice to see them growing their dividend. It's nice to see that their strategy around power brands looks like it's paying off, because they're starting to see some growth there. My issue with them is we're not seeing real growth. The growth is still coming mainly from price increases. It was 1.7 versus 1.3, and I want to see that tilted the other way before I'm really convinced about Unilever. So I think you would call this a solid kind of foundational kind of earnings, but it doesn't blow me away. But I do appreciate the 6.1% dividend hike, I have to say.
Yeah, and what is also good to see is just that they're back on growth.
Yeah, of course.
Yeah, because that's what the issue was for a few years. And any feeling about the new CEO already?
Not really. He's still kind of implementing. We're still seeing the rhetoric from the last CEO, so it's unfair to judge him on that. So I'm actually looking forward to the Capital Markets Day, because we might get a good feeling of what he wants to implement and what direction he wants to go. But look, it'll be good to finally get this ice cream business spun off, because we've been speaking about this for 2 years now, and it hasn't happened. So it'll be good to get that finally closed off. And then see how they're going to grow this power brands and what direction he takes. But like from where we were 2 years ago, it's much better from Unilever.
Yeah. And do you know if the spin-off will be share issued to us?
It did not say in this, so I think more details of that will be in the capital markets. So they're saying, but
would you like to have the shares, or would you like them to just take the cash and put it on the balance sheet?
I probably would like to take the cash and put it on the balance sheet. I'm not the ice cream business and not too
Yeah, so special
fond of it.
dividend would also be nice, something like that.
Special dividend. Now I don't hold Unilever, so it makes no odds to me. But
Okay, yeah, so I hold quite some Unilever.
yeah,
I would also agree. It's also interesting that they didn't sell it, right? So that means there's no buyer for it.
they tried.
Yeah, but that's what I mean. No,
Yeah.
they couldn't get probably a proper price for this.
Yeah, so that tells you a lot as well.
Yeah.
They've been trying, so quite
Yeah.
quite interesting. But then we got asked the question about Unilever and PG later on. But when I was looking at Unilever, I said I might as well have a quick look at PG. I didn't go too in depth into it because it's good to compare them, right? And I didn't sound too positive about Unilever, and I wasn't when I was reading it first. And then I read PG. And while I was reading PG, I was like, actually, Unilever did okay. So PG reported net sales around 19.8 billion. This is actually a 2% decrease on last year versus a 1% decrease from Unilever. Their earnings per share grew decreased by 1% as well. But when you look at their segments, look at beauty, grooming, healthcare, you can also see the same. Volume is either flat or down.
Yeah.
Most of their growth is coming from pricing. And actually, when you compare both of them together, I would say Unilever did a little bit better than PG. So that kind of tells you a lot about the current market, how that space is at the moment, how competitive maybe tariffs or increased prices is impacting it. The only thing you'd say about PG is they have a better dividend history, but if you're to go earnings over earnings, Unilever actually did slightly better than PG. So yeah, it was only when I compare both, I actually had to rein myself back on Unilever and say they didn't actually do too bad.
Interesting, right? So maybe that it's now a little bit the decade of Unilever that's upcoming, while the last decade was definitely Procter & Gamble.
Yeah, and it seems Procter & Gamble are more focused now on cost cutting and innovations, and when that happens, the growth is gone and they're struggling. So
they had the current shareholders from Unilever, right? This
of course,
activist was at P&G before and now here, so maybe they try to do the same trick and it seems to be working.
Yeah. So I take back my negativity on Unilever based on PG, but look, it's a tough space for both of them at the moment, and I would say both of them did fairly okay given the circumstances.
Yeah. Good. So what's more than I can share really briefly on Texas Instruments because they responded quite well on the stock market, and then people are wondering, but wait a second, their dividend is not covering the free cash flow, as an example. But I would like to remind again, like, they are going through an investment cycle. You could argue that the years leading into this investment cycle, they have probably underinvested. Because usually you don't want to see such volatility in the investments. You expect that to be kind of flat, slowly growing here, but they've been squeezing out for a long time, and then suddenly, okay, we need a few new plants here, right, to meet the new demand and to upgrade. So in this case, for me, it doesn't really make a lot of sense to look at things like net income, free cash flow, because we know those look bad. Yeah. But revenue is really the killer here, and they grew revenue by 11% year over year. We know it's a cyclical business, but under those circumstances, I think this was a really, really good quarter. And that's why I understand that the stock market is rewarding it. The investments are generally on track. So I believe still 1 year or 1.5 years of this CapEx. Then it should slow down. It will not get any more back from a CapEx level, let's say pre-investment cycle, because they have a higher baseline now. I guess they realize they need to continue this. So that's why the dividend is not covered, guys, from the free cash flow. It's really as simple as that. So what you just need to pay attention to is, like, is revenue growing? When do those new factories come online, and are they fully utilized, and do we see it back in sales? That's really about it.
And of course, the balance sheet is strong enough to take this on for a
There's
little bit.
a very well managed company, and it's really not an issue that they're leveraging up a little bit. It's not getting shareholders into trouble. The trouble will come if they would have bought all those plants and manufacturing capacity, and then there's no sales.
Yeah.
That's when the trouble comes.
Yeah.
Hint, Intel.
Yeah, exactly. Big hint, big hint. What I will say about Texas Instruments is we recently have Hussein, who's on our Facebook group. So anyone who's in our Facebook group will probably know Hussein. So he does some writing for us on our premium newsletter, and he did a nice, I would say, a really nice stock card on Texas Instruments this week. It has, I think he's captured the bear and bull thesis very, very well. So if you're a premium subscriber, read that. Reach out to Hussein on Facebook. But I think it's really good to check it out. But yeah, I mean, Texas Instruments, for me, no point looking at free cash flow, but they are still going really, really strong. So could be a good time to buy them, because I think once this manufacturing plant and all this comes online, they might take off and share price again.
Yeah. It's for me also something that I was looking at actually pre-earnings. Shall I buy still few? But I thought like, no, I have this rule to not buy 1 or 2 days before earnings, rather to miss out a jump than to speculate the day before, because that's all about being a patient investor, right?
Yeah.
Because it is a relatively good size of an investment, but I still have quite some opportunity to invest. And it's now yielding 3.3%, if I'm correct. So I can still invest quite a lot. I have a decent profit on it as well, but 3.3% is a good yield. But maybe on the dip, if you can get it for 3.5%.
Yeah.
I know there are many people that don't like Texas Instruments, right? But for me, it's like a well-managed company. I've been following it for a decade now, and management is top-notch there, really.
Yeah. Well, look, it is a cyclical company, and if you're looking at this company with fresh eyes now, and you're seeing those free cash flow numbers, you're probably closing your eyes in fear, going, no, I'm staying away. So it's a case of knowing what you want, or you can't follow
exactly. And this is why you do business analysis. You need to understand, and you want companies to invest for the future, because Intel didn't do it at the time. They were too late, and now Nvidia and AMD are gone with the revenue from them.
Yeah, exactly. And at the wrong time, when you think of all this AI boom as well. Like Intel had such an opportunity before. So yeah. We'll continue with some European companies. ASML.
Staying in the chip industry.
Yeah, let's stay at that. So if you look at the first quarter sales, it was 7.7 billion. We know that the CEO has said already that 2025 and 2026 will be growth years, because we had last year was kind of a foundational year. 7.7 billion in sales compared to 5.2 this time last year. So you can see there's quite some growth there. They've also improved their gross margin by 3%, 51% up to 54%. That trickled its way down to net income, which we see has increased, and obviously earnings per share has nearly doubled in that time. Interestingly, they've only sold 7 more units compared to what they sold in this time last year, so their prices must have gone up quite significantly. So look, we're expecting a lot of growth this year and next year from them. The AI boom is really, they're really in the thick of that, and they mentioned that again in this earnings release, that artificial intelligence continues to be the primary growth driver. Now, we haven't talked about tariffs in any of the other earnings so far. This is the first time that I've seen it mentioned in the reports from today. I've seen it before that, obviously, but what they said is, our conversations with customers so far is our expectation is 25 and 26 will be growth years. However, the recent tariff announcement has increased uncertainty in the macro environment, and the situation will remain volatile for a while. They didn't change their guidance or anything, but they're kind of giving a heads up here that if tariffs continue, it might impact them this year. But
it will probably impact margins, because they still want to sell the machines, but then they need to probably give a bigger discount. Of course.
They still have plenty of orders on the books, so they have to deliver on those. But margins will definitely be impacted. And the only other thing I noted was their free cash flow was negative. It was negative this time last year. It's also negative again this year. But when you delve into it, it's down to changes in assets and liabilities, which is basically working capital. Inventory has gone up, accounts receivable has gone up, and that's where you're seeing it. So nothing nothing to be really concerned
Yeah.
about. So,
It reminds me, Nathan, from last week, who said, like, now we're going to see the companies that truly have pricing power.
yeah. And I'd be surprised if ASML is not one of those.
Exactly.
Let's be honest. But yeah, look, strong quarter. It'll be interesting to see what tariffs do to a company like this, because maybe people might hold off on orders until this is sorted out, or they might just relax on them, or will they try and rush them through?
Yeah.
So it'll be interesting to see. But look, another. I mean, clockwork earnings from ASML, I would say.
Well, hey, while we stay in the technology, let's go to SAP then.
Oh yes.
I just wanted to really quickly, SAP is really on fire. They grew the cloud revenue again by 26% to about 5 billion. So SAP is really doing it. It's interesting, right? Because they're with a cloud business model, if you talk about a vendor lock-in as a company, once you have SAP, you can't really get rid of it. But if you're in their cloud, you really can't get rid of it. Yeah. And talking about pricing power, you can effectively in the cloud, you can just raise the prices, because what will the company say? Let's turn it off.
Yeah,
I don't want it anymore.
Yeah.
No, you've sold your soul. You've sold your soul to the devil, effectively. Yeah. But hey, if you're the boss of the devil and you own it, then why not? Yeah, that's what capitalism is about. But yeah, very strong earnings again, and I'm such a person that bought SAP at 90 and sold it at 120, because I felt like, it was undervalued at the time, so it was not a dividend growth investment for me. But then when it went to 120, I felt like, there's not so much I like about this company. They were late in the cloud, very late, yeah. But when you have a monopoly there, or when you have such a vendor lock-in, then you can be late, yeah. In this case, but I just didn't. It's one of those companies where and many mystery is very familiar with it. It's such a company that you hate and you love at the same time. Yeah. Because we may complain sometimes about SAP and the complexity, but let's face it. If you look at competitors like ServiceNow and such, it's the same shite, Derek. It's the same. It just follows the complexity of the businesses. And when you're a large corporate, it's so huge. And these are one of the only software companies like SAP that can actually meet most of the requirements. It's just very expensive.
That's it. But then you look at this cloud growth. I mean, 25%, 27%.
These are the Microsoft numbers.
These are crazy numbers. I mean, they were late to the game. I remember you talking about SAP, about their lack of innovation in the cloud, and they came late. But man, they turned up late, but they've made an entrance, I would say.
Exactly. And of course, they've cannibalized the whole legacy business, but that's okay, because this is a better margin. So
yeah, exactly. Nice one. So we might finish up then on PepsiCo, and lots of people talk about PepsiCo, and really, I spoke to you slightly off air about this. I don't know what I'm missing with this company, but net revenue was down 1.8%. Obviously, foreign exchanges had an impact, so it was actually down 3%. Earnings per share was 133, which is down 10%. And what we're seeing, again, they mentioned tariffs, so they're expecting more volatility. What we're seeing here is a weak consumer. But the one thing that stood out for me again, and it grinds my gears a little bit, but they've had negative free cash flow again. And I think this is like 4, maybe 5 quarters in a row, it's just negative free cash flow. When I look online, I know they're a dividend king. I know they've increased their dividends quite aggressively over the last few years, which bemused me a little bit, because everybody's so happy, but I'm like, I don't see how they can do this. I mean, their payout ratios are sky high. Their free cash flow is now negative. And it seems to be coming from their accounts payable. So they're not paying off. They're not paying off their people. They're just keeping it, and it's increasing their accounts payable. But I don't know what I'm missing here. I mean, Simply Safe Dividends has them as a 90-something safe dividend, and I just don't see it.
Yeah, me neither. I mean, the cash flow is just not covering the dividends. And what for me the biggest issue is, Like you can have a high payout ratio, you can be a dividend king. They don't have a plan.
I
There's
don't,
just
s- I don't
I
see the
don't
growth.
see a no, I don't see it either. They are acquiring some small companies, and of course they can give it the global supply chain and scale it up and everything. But I have a feeling they shot a little bit. They overplayed their hand a little bit over the last few years with some of those dividend hikes that were far beyond the earnings growth,
I think
which
so.
puts them now in a really difficult position because debt is also raising. And you know how we think about it, right? And a 100% payout ratio plus debt raising with no forward, it starts to make the dividend really questionable. Yeah.
Yeah, I mean, I get a lot of people disagreeing with me about this. I've been quite bearish for the last 2 years, even though their dividend hikes have been quite high. But it just looked like they were running into trouble. I didn't see where the growth drivers are coming from. Where's that real growth actually
Exactly.
coming from? And I still don't see it. I just see
Yeah.
this. I can see them going to 1 cent dividend hikes in the next few years because they'll have nowhere
Mhm.
else to go. But
Yeah.
I mean, look, I'm open to people to prove me wrong or to tell me where the growth is coming from. But I just don't see it, and I can't see how that dividend is sustainable at these prices. I mean, I can only look at the numbers and look at the data that's presented, and I can't. I just can't see it. But yeah, look, I think it was a disappointing performance from them this month. They're obviously under pressure. They've got
Mhm.
a weak consumer. I mean, you compare them to Coca-Cola, and I think Coca-Cola are far better managed. I would argue, but yeah, I would say disappointing all around. And tariffs is not going to help them on top of an already, like, I mean, they were down 3% without any tariffs. So if tariffs take into effect here, you could say that they might be down nearly 6, 7, 8, 9%, which will be
Mhm.
quite
Yeah.
big for them. So the forward guidance has actually seen them now. They've lowered it from mid single digit growth to
Mhm.
flat. I mean, that's a big jump.
Yeah.
That's
Yeah.
in,
Yeah.
in,
Yeah. Yeah.
in 1 quarter. I mean, like it's only been 3 months and they've already downgraded their things. So that'll tell you where they're at. But look, I just don't see the attraction with Pepsi. I think there's far better options out there. And yeah, not for me. A dividend
No.
king, but I don't have confirmation bias. So,
No. Same here. I'm not buying. Yes.
no.
So I've got a small initiated position, but I'm not buying, and I will not buy more. And I know on social media everyone's saying like, "Oh, it's first time in many years for 4%." But yeah, well, there are many other stocks that you can get for 4% that have a much better safety rating.
Yeah. I mean, sometimes you can get hung up on that, can't you? Or it's the first time a company has been here in X years. There's a reason for that.
Yeah, exactly.
Sure, there's a reason for that. So you have to look at the data, you have to look at the numbers and look at their future outlook. And I could forgive them having high payout ratios if the growth was there.
Yeah,
But it's not supported by growth for me. So I just
exactly.
I can't support it.
Yeah.
So there we have it. I don't think there's any more earnings. Is there? Is there anyone we have forgot?
No, that's it.
Yeah, nice. I think a nice mix. I think positive overall. I would say.
Mm-hmm.
I was a little bit harsh on Unilever. I take most of that back. And Google was quite strong. So let's move on to some listeners' questions. And the first one is from Dividend Controller, and I like these types of questions, right? So if you have to give the keys to your portfolio to somebody else,
Yeah.
who would you give it to? And we can't give it to each other. So who would you give it to and why?
I will give it to my wife. And why? She wouldn't know how to log in and use the keys.
And what did they say? Most of the best performing portfolios.
Exactly. There you go. The only thing is like she would be very wealthy but still poor because she wouldn't be able to cash out.
She'd have no idea how much it's worth ever.
No, well, she would not be able to get the dividends from the account.
Nice.
Yeah.
I had given this some thought. I was thinking about who I would pick, and the first one was like someone like David Fish. Well, I know who's passed away, but someone like that to manage my account. And then I thought, do you know what? Maybe one of our guests who's already retired from dividend investing. And we had the Canadian
Oh,
investor on, didn't we?
yeah.
Who's already retired, so he knows how to manage a portfolio. He's living the dream, I would say. So
But
that's why.
maybe he got retired by others giving him the keys as well,
Yeah, well, hey, look,
and then taking all the money out.
maybe it's a good plan. That's a good
Yeah.
plan, but yeah.
No, but honestly, of course, I'm making the jokes about my wife, but it would always be my wife. I mean, I
Of
want to keep
course.
the money in the family. At least if someone squanders it, it's my family that at least then has a bit of joy of it, right?
It would be my oldest son over my wife because he actually has an interest in it. So he would look at it, but he would also look after my wife. He would make
Yeah.
sure that she's okay. So I would pass the reins over.
Yeah, I think, yeah. No, but my wife will do well with it. She's having the right mindset when it comes to it. She's just not knowledgeable, but I've written a document explaining a lot and explaining her to call you as well for some advice.
By
Yeah.
Google.
Yeah.
No. Hussein has asked a question. So there's a quote from a book, and I think quote from the book of Pulik Prasad or something. I don't know the book personally, right? But the quote is, I understand some investors project 1 or 2 years of earnings. It's not ideal, but he gets it. What he doesn't get is they do something much worse, and it's called DCF, or discounted cash flow.
Yeah.
So what do you think about the applicability of the dividend or discounted cash flow in general?
So I understand why people often challenge like this, because they say, like, how do you know how you make these assumptions, and these assumptions are, you could as well just throw a dart on the wall, right? I think a little bit different about it. First of all, investing is personal. You need to figure out what methodology works for you. Now, I spend a lot of time in understanding the company. I therefore also spend a lot of time on understanding a little bit the earnings trend. Now, if I have a high confidence in the earnings trend, or at least I feel like, yeah, it's relatively understandable, then I like to do a DCF. And why not? Yeah, you want to understand a little bit of what the value is of a stock, because otherwise you're entirely guessing. Yeah, so for me, it's like turning the knowledge into some assumptions. But then you need to, of course, in the upcoming quarters and year, you need to verify if your assumptions were right or not. But you know what we also do when, for instance, a Shell, I don't use DCF for Shell. It makes utterly no sense.
Yeah.
That's why you use the dividend discount model. Do you think the dividend is safe? Yes. Do you think the dividend can grow across the cycles? Yes. Then dividend discount model is much better. And others will just go with the PE, or the others will go with PEG. Yeah, the price earnings divided by growth. Yeah, there are so many valuation models that are out there. You can go by book value, whatever. For me, DCF is nice because I spend time on the earnings trends, where they come from. I look into the margins. That's why it's something that works for me. But yes, of course, everything takes assumptions. And what I also do is I often play a little bit with those numbers to see, like, what the margin of error is to the fair value, because sometimes you have like one of those values that can give you like almost double the amount out of it, and then you need to be really certain about this, or just acknowledge, like, okay, I don't know, but I want to have it or not. Yeah.
I would argue almost all valuation methods have some form of assumptions in them, even if you stick with the simple PE ratio that people,
of course, because you assume that the earnings are right.
Yeah, exactly. You're assuming the earnings are right, and if they have a higher PE ratio, say they have 28, you're assuming they're going to grow into those earnings. They have a higher growth rate, so there's always some sort of assumption behind them. I think the good thing about going through the process of a discounted cash flow is you have to really think about it. You have to think about what numbers you're using, why you're using those numbers. You can't just plug random numbers in and go, right, 6% and this and expect to be right. You have to actually put some thought behind it, which means you need to understand the company, where the cash flow is coming from. And
the hardest with this is not what you plug in. The hardest is when you start fooling yourself.
Yeah, of course.
Because what I've seen in the past, and you see this with analysts, that the fair values, they always follow the share price. And we have, for instance, in our premium service, sometimes a stock that is maybe trading for $900, and we say like, no, look at what they are growing. You shouldn't pay more than $400 for this.
Yeah.
Yeah. And then, but then, for instance, the stock market, darling, and people may think like, you guys are too tough on this one, whatever. No, look at Spirax.
Yeah.
It was on 15,000 pence. It's now 5.5 or something like that. It eroded 70% of its entire market cap in like a single year.
It's crazy. It's crazy.
And we have always said it's overvalued. It's overvalued. It's overvalued. Finally, it's kind of in this range now. And it's still only, what is it, yielding 2.9%?
Exactly. So
for an engineering company, right?
And for me, because I studied that company and I did a discount cash flow on them, and for me, it is now only trading at what I projected right now.
Exactly.
And that was without me putting in a margin of. I usually put in like if I'm investing, so I'll have my fair value, but I will maybe use 10, sometimes 15% margin of error because my assumptions are my assumptions. So like I still wanted to trade 10% lower than where it is before I'm interested. Like that's just the way. I mean, look, everyone looks at valuation differently. There is a lot of assumptions there, but I think the most important thing is that you have a method, but you're thinking about why you're using
it.
That's for me the most important.
And really don't fool yourself, guys. If you use a DCF or a template, don't start adjusting your assumptions. For instance, don't take the free cash flow totally on the high end so that the number comes closer to the share price and you think like, oh, it's fair value, so I can buy. Then just be honest to yourself that you are really on the high end of the expectations and that you're pricing it for perfection. So just prepare yourself for disappointment.
Yeah. We have lots of fun conversations about that because obviously we write our own stock cards. And our valuations then, like sometimes I'll be on the high end, sometimes on the low end. And
sometimes I ring you up. What are you doing, Derek? You've not considered this.
And then we talk to our rationale. You go, okay. Now I understand where you're coming from. I don't agree, but I understand. So
exactly.
But it's part of the fun. But for me, the interesting thing about the DCF is just that thought process of what has to go behind it for you to make those assumptions. And once you do that and you're comfortable, I think you might be not right, but you have a more chance of it going in the direction that you wanted to go in.
And oftentimes I notice that the outcome of my DCF is very much in line with it having a certain yield or it having a certain PE ratio. So if you think about it, if you go for, if you think like, such a stock should only be 15 PE, let's say, and it has a 60% payout ratio, you often come around 3.5% dividend yield as well, right? So it's funny that all of these in the end, when you do many of those, they all come all together in a sweet spot. So that's my experience. I can't even say it factual, but I've observed it so often that I feel like, I've done all the business analysis, I've done the whole DCF, and in the end, it's just a 15 PE. And I think like, why did I went through this whole process?
Just skip everything and put a 15p and
it's fine.
We're done and dusted. Nice one. David has asked us, you invest your time and efforts into these episodes. Then the question is, which platform pays the most dividends, Spotify or YouTube? So besides my subscription, I can pick the better platform. Honestly, I think Spotify is the best platform to listen to. We don't earn a cent from Spotify. Nothing. Not 1 cent. Nothing. Nada.
We don't do ads either. No. We do nothing. No affiliates.
YouTube is I mean, it wouldn't even buy me a packet of crisps in Ireland. It's very, very small money. And honestly, we don't care about the money on YouTube. So I would say the best listening experience is probably on Spotify. So stay on Spotify, David. Don't worry about it.
Exactly. Don't worry about us.
Yes. Dividend XE. Have you guys looked into an ETF? And the ticker symbol is H4ZA.
Yeah, it's SBC Euro Stoxx 50 UCITS ETF distributing.
Yep.
And interestingly, I have never looked into this and I'm very impressed. So they pay the 88 cents in dividend in 2021.
Yep.
And now they pay €1.54. That's nearly double. It currently pays a dividend yield of 2.85%. So it doubled, over that time. And I'm quite impressed with that. Secondly, I'll tell you the top 10. ASML, 7% weight. SAP, 7% weight. LVMH, 4.6% weight. Siemens, 4.3% weight. Schneider Electric, 3.5%. Total Energies, 3.4%. Allianz, 3.4%. Deutsche Telekom, 3.2%. Sanofi, 3.1%. And Air Liquide, 2.7%.
I mean, have they been listening to our podcast and reading our newsletters? I mean, the only company there that we don't really touch on
It's Deutsche
is
Telekom.
Deutsche Telekom.
Yeah.
That's.
I'm impressed. And it still yields nearly 3%.
Yeah. The only problem for me as an Irish resident is we know this deemed disposal, but then also it's distributing. So if I was to buy an ETF, it would have to be accumulating for tax reasons. But I mean, this looks really, really good.
This could be the first one where I'm like TDIV from Van Eck, Dividend Leaders is a really good one. But I need to dive deeper into this, because this one definitely piqued my attention, because one of the first ones where we see continued dividend growth over the years.
Yeah. Dare I say it? Will it be an SCHD alternative for Europeans?
Yeah, but it has a lot of weight in tech, right? Of ASML and SAP making up 14% of the entire index. Yeah, so,
of course, but the top 10 is 42% of the overall holding. So I still think 7% is acceptable.
True.
I mean, there's a lot of opportunity.
But it's a very strong top 10. If this is your portfolio, it's a very strong top 10.
I mean, we haven't done a portfolio review in quite a while, but imagine we got this as the portfolio review. We'd be sitting there going, wow.
Exactly.
Yeah. Dividend, appreciate that. Thank you for bringing that to our attention. It's definitely worth a further look. I will look into it, even though I will never buy this until Ireland sorts out its tax rates. But I mean,
will you put the ticker symbol and such in the description?
Of course, yeah.
Cool.
El Cuba has asked us our thoughts on PG and Unilever. I think we've spoke about that earlier. So I think PG did slightly worse than Unilever, but they both did okay. But the second question is thoughts about SAP earnings, and we spoke about those as well. So I think we covered them. Very good. Peter's asked us about Pepsi and PG. We covered both of them. And then the last question of the day comes from Anders, and he's asked us for our take on a company called Lincoln Electric, ticker symbol LECO. It's a mid-cap company in the US, and they have a good moat in the welding space. So apparently, it's the primary choice for welders in the US. I don't know a whole lot about the company. He's also mentioned that they're getting into the space of making chargers for EVs. But Russ, I'm sure you're listening. As the #1 dividend welder in the US and Canada, I believe, I think Russ might be the best person to answer this. I actually think he is the best person to ask about this, because he would know that company very well, I would say. I'm always skeptical of going into companies like this. You know, like welders use a certain brand, because I know we have it with Snap-on, but I always feel like that can change quite quickly. But I mean, I don't know this company quite well, so let's ask Russ his opinion and see what he says.
Yeah, sounds good.
Yep. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.